Good afternoon, everybody, and welcome to our panel discussion on liquidity and fragmentation, an evolving landscape that we all have to adapt to. My name is Andries Potgieter, Head of Electronic Trading at Investec Markets, and I will be the moderator for this panel this afternoon. I think for a start, I want to kick off just extending a big thank you on behalf of Investec and myself again to the JSE and our fellow sponsors for putting this great event together. I think, as we said earlier, it's really about collaboration and getting people together in the industry to talk about topics that's very important and real to us, and to look at ways how we can solve some of these challenges. If we look at today's market evolution, and we look at a lot of the things that are changing and the complexities that are coming with this, it's becoming so much more important to really understand the diversity of liquidity sources that are available, and to understand, with all the additional venues, we see multiple exchanges, etc. We need to really think about what that means for liquidity and what it means for price formation. So for us as a panel here today, these are some of the very important aspects that we want to delve into. We're going to look at a couple of key aspects and a couple of key topics, and we'll get to the panel to really talk about these key topics. But I want to set the tone. We're going to look at the diversity of liquidity sources, as we said. We're going to look at multiple venues, multiple exchanges, and what it means for price formation, and how the different sides, the buy side and the sell side, have to contemplate these aspects. We're going to look at technology and how technology is playing such an important role in solving some of these complexities for both the buy side and the sell side. We're going to look at the development that we've seen of auction volumes, and how auction volumes are continuing to actually increase. And we see up to 30% of daily activity for certain stocks taking place in the auction. And these things obviously create certain challenges and opportunities that we both, as buy sides and sell sides, need to really think about. So, other aspects that we really discussed leading up to this, we talked a lot about deal-listed liquidity in South African stocks, and how these deal-listed liquidity is something that you really need to consider, in trading. Some of these names, you look at things like Anheuser, etc., it's multiples of the daily ADV that actually trade in some of the offshore markets, and you need to consider this in your execution, and our panelists will obviously bring their views associated to this as well. We'll talk about the banks providing liquidity in certain cases, and facilitation, and how important that piece is, and also obviously the potential implications that could have. But again, at the end, there are a lot of different aspects that we need to consider. The panelist that we have here today brings a wealth of experience from the buy side and the sell side, and we really want to engage on this and hopefully give some insights to the community. As I said, it's a collaborative effort, and without further ado, I would like to introduce the panel. On my left, I have Siobhan Agu from 91 Asset Management, trader. We've got Chris from Liquidnet, Chris Jackson from Liquidnet, who's head of EMEA Equities, and we got Vet Samera, head of equities and collateral at Nedbank. So, gents, thank you for joining us today. I want to go to yourself, Siobhan, and really get into the diversity of liquidity sources, and really understand, as the buy side, your perspective on this, and what it means for your day-to-day trading.
Thanks, Andries, and thank you, the JC, for having us all here today. It's a great event. It's my first time, so well done for the successful event. Yeah, look, liquidity is a topic that's it's on top of our mind all the time. Both the buy and sell side knows how tough it's been, and it presents a number of challenges on execution. For us, given the size and depth of our flow, there's a few things that we always need to consider, and that makes me think specific sector names would result in me either going to a high-touch desk or going to a low-touch platform or using a dark pool platform. And certain elements of that comes on the history of how successful an institution is or platform is in executing that flow. Another really, really important element, which a lot of the brokers and the banks know that's important and critical to me, is the trust element. So when I joined, I always told guys, if I have not met you face-to-face, I'm not going to trade with you, because I need to know that when I am leaving an order with a particular institution, that they are going to take care of it to the best of their ability. And that also impacts a choice of platform. So it's not just the liquidity element, it's the liquidity element plus your way of executing it that's really important for us. I think specific names, such as we were just discussing some small to mid-cap names, may be more, we might find better liquidity in a dark pool platform. And there's some names where I feel, depending on the size of the ticket, that I can manage myself using a low-touch platform. But then a predominant amount of the time, the high-touch element of the high-touch desks is key and it's critical, because the traders and the sales traders have those relationships with other institutions, which we try to leverage off in order to execute flow efficiently. So.
Yeah, thank you. Ved, anything that you would like to add on this from your perspective?
Thank you, Andres. Thank you very much to the JSE for this conference. It's really nice to see that as an industry and as an organization, it's really growing in terms of collaboration between the different parties. Siobhan, great points you bring up in terms of liquidity. I think as an industry, we have to sort of look at where we've come from and why we are here from a liquidity point of view. I think it's very important to note that we've had a reduction in our weightings in global benchmarks. That's MSCI. We've obviously had our own sort of internal, let's call it micro issues with, let's call it the credit rating downgrades. We've had the gray listing. So this has sort of led to this decrease in just general liquidity in the market. Equity markets, if you look at it from a volume point of view, has been pretty much static over the last few years, despite, let's call it the benchmark top 40 going up. So it actually means volume is kind of less. What this has meant for us, right? What this has meant for us is we've had to play in a space that is in a decreased volume space, but we've had to provide the best execution to the client. So Siobhan, to your question or to your comments is, as brokers, what we try and do is, our main aim is to look at least cost sort of execution. And with that, I think, and it's actually quite crazy that no one's actually brought up the word AI in this conference yet, right? But if you had to really look at equity markets for the last, let's call it 20 years, we've actually used AI in actually 20 to 30 years, right? We've actually used AI in equity markets, in equity algorithms, right? If you look at how you execute in the markets on a, let's call it a VWAP basis, or a participation basis, or implementation shortfall, this is all based on regressive data, which we've put into systems, which is allowing us to execute for the client's best basis in terms of least cost. So 100% in terms of Siobhan, we need to, as sell side, and I speak as not just the institution I work for, but as a real community. I think everyone's trying to work in the best interest of what client liquidity looks like and how we execute in the best case for them. Thank you, Andrew.
Cool. Thanks. I mean, Chris, if I can lean on you, just what you've seen, with your experience in global markets as well, some of your perspective.
Sure. And again, to echo the other panelists, this is my first time at this conference, but thanks to the JSE. We've been working with them for over 10 years in this market, but it's great to see such a great conference being put together. It's a real pleasure to be here. So again, thank you to everyone for their time today. If we're looking at the markets are clearly evolving, and if you look at there's always been a role in any market in the search for liquidity in a number of diverse sources. It might be principal risk, it might be lit market, it might be crossing in dark pools for some context. Dark crossing in Europe is around about 12% of total market volume. If you look, and what is the electronic process of dark crossing? It's really just a natural logical extension of the high-touch agency cross process that goes on in all markets. And indeed, as we look at how we affect this with the JSE, we use their block trading markers, which are intended for that high-touch process. But it is important as markets evolve and become more electronic, and we talked a lot. It's fascinating to hear your colleague Will talk about the change and the juniorization of the sell side and the resource constraints that have been under them. That's created an environment of further electronification, and I strongly believe that the route forward for markets is not simply an electronic mechanism or a high-touch mechanism, but a careful synthesis of the two. And the value that a sales trader brings to the execution process is extremely high in terms of market insight and value and trust. But equally, the ability to distribute electronically and efficiently means we can do more with less.
Chris, I think I really like what you said there around the block liquidity workflow being really very similar to what you see on a high-touch desk. And it's about bringing parties together who really want to transact. They want to transact in an anonymous fashion, but they willing buyer, willing seller, and there's a workflow that then brings that onto the market and put it onto the exchange ultimately and report. And the other piece that I think that really rings true to me, both from you, Sean, and Chris, is the human element. I think for us, we've seen that as well. It's extremely important that people understand who they're dealing with ultimately, even if it is via the electronic channel. There's a very important trust element, and there's a service element, execution consultancy piece that very much goes with that. So thank you for those comments. Appreciate that. So I think the next piece we talked about really thinking about what it means for price formation. I think, Sean, in our preparation up to this, you mentioned, we're now kind of going in a multi-exchange environment in South Africa as well. We got all these different places where you could potentially access the liquidity. But what does it mean for price formation? I think it's an important aspect that we need to kind of consider. There are some comments that you kind of want to kind of make around that for us.
Yeah, look, I think that it's really important. So the CLOB book will always be imperative, will be important as a starting block. But now these days we have a lot of systems that plug into this, be it an algorithm or high-touch desks, where you are seeing, and different exchanges as well, where you are seeing best bid and best offer trying to compete with each other. So sometimes, actually more often than not, I see this as a bit of an issue, and it's frustrating when you have these algorithms that are always trying to create price that's not a true reflection of the security at that point in time. So I think we need to make sure that the low-touch providers and the algorithms that plug into the different exchanges do so in a manner that they keep price efficiency at bay. And it also helps avoid incorrect levels being executed on, which becomes self-fulfilling in a way. So, for example, if MTN, as an example, was trading at $115, but there are multiple algos that are trying to buy the stock, and it's going to push the price all the way up to $116 because the parameters have not been set correctly. So I think price formation is always important, and we just need to make sure that everything that plugs into the exchanges and into the central order book is done so in a manner that keeps that under control.
So I'm hearing that you really want to ensure that the integrity of the price formation on the central order book remains, and that's absolutely
100%.
critical to the foundation of the market. I mean, Ved, is there anything specific from your side
Siobhan,
that
I
you've
think
seen?
you bring up some good points, right? For me, I think multi-venues are pretty symbiotic, or have a symbiotic relationship for actual liquidity providers into the system and the end client. The reason I say this is I start looking at liquidity on an exchange on a global scale from a sort of multi-layer form. My first layer is sort of your quant type of funds who are also liquidity providers. Your second is your passive management, and let's put some derivative hedging into that. And the third is your natural active buy-side client. So for me, in a sense, where I started off talking about we are in a constrained liquidity market in South Africa specifically, we have what we have to work with. It's actually encouraging to have liquidity providers and quant funds come into the market to sort of stabilize the market over different exchanges. So Siobhan, to your point, if you've got algorithms that are running wild on one exchange or one venue, may I put it as such, having this technology that's coming into the market creates stability, number one, and creates price formation in a more, let's call it, from a liquidity point of view, that's more in line with the actual fundamentals of what's going on with the stock at a point in time. So for me, I think having multiple venues and these different types of, let's call it execution players in the market creates that stability, because that's what the market's looking for, that stability in liquidity. It's the quality of liquidity.
I'm hearing you saying that there are a number of diverse players in the market, and we need all that liquidity in the market ultimately to give an environment, that could give more stability in certain times when things do start to potentially disconnect.
The one point I'd like to add as well on that is, again, we are in the backdrop of it's very difficult to get foreign investment in. We actually had a great speech by Abel Sitole. He was very inspirational in terms of what we have. But I think the one lesson from him is we have to work with what we have and sell ourselves, have the lipstick moment, right? The red lipstick moment. And if we can show the world that we've got stable markets, stable exchanges, stable venues, we can attract the flow in from that point, looking at more the quant funds coming in, the liquidity providers coming in, and that just brings the whole universe into a better step.
Fair. That's good. I think, Chris, from your side, I mean, maybe just to touch on the positive impact of technology and what you've seen. You know, I think we talked a bit about the workflow piece, but it'd be good to hear your perspective.
Sure. And perhaps before I do that, I'll just make a quick comment. I think backing up what's being said here, that question about price formation is a really important one. And if you're looking at putting lipstick on, you need, what does lipstick for a market look like? It's a fair and well-formed price for the asset and good liquidity. And I think that there's been a real misstep here if I look in in Europe. The UK, for instance, doesn't consider alternative sources of liquidity, bilateral trading, off-market crosses, dark pool crosses, into some concept of what liquidity across the total market looks like. As such, they are cutting their nose off to spite their face, because the appearance is to the asset management community that this mid-cap name is really illiquid, just because people have chosen not to necessarily trade it on the primary exchange. And so before you know it, it becomes a self-defeating prophecy where the compliance department at the asset manager won't let you invest in that asset because it's not got a suitable level of threshold liquidity.
Yeah.
Whereas in fact, if you took a broader view of what that liquidity was, then that would be far more investable. So, and we see this, all of the prints that we do go through the JSE and form part of that tape.
Yeah.
And I know there's been some questions around whether that causes overtrading. I think we'll get on to that a bit later.
Yep.
But actually, I think it's the same as the US, and I think it's the right approach. Talking about the impact of technology, we have seen, and we perhaps touched on this a moment ago, but your ability as an individual, I go back to when I started in this industry, you'd have one sales trader who had 10 clients that mattered and could be everything to those clients, but also served a purpose where they were the single gateway to the market. If they were a market maker in that stock or corporate broker to that stock, they'd have a complete picture of where liquidity lay. Yeah. And so there really was only, as I would hazard, as an asset manager or dealer in those markets, you'd have a view on the small and mid-cap space in particular that there was only one place to go. Because that was the name, they were the broker in that stock. Because markets are fragmented, electronified, coverage has juniorized, there isn't necessarily that same body of knowledge resting in one place anymore. Yeah. And so that process of liquidity discovery has to look in so many more places in an electronic way. And I think that has to be embraced. And if it is, it creates a very strong tool for liquidity discovery.
Yeah. I mean, I think that's a very interesting point. I think we've seen that in terms of looking at the counterparts we transact with in Europe and the UK, and knowing that some South African stocks have been transacted away from the JSE between these foreign counterparts, but now we really kind of looking at solutions that allow us to actually interact with that liquidity and bring that liquidity back onto the JSE and printing it on the JSE. So as you say, it's a natural evolution that's taking place that the market has to embrace, and it's not a case of the broker can just phone these specific sources of liquidity. You have to access it electronically.
Yeah.
So that's really interesting. I think the next piece that I would like to touch on and really think about a bit is the deal-listed liquidity. I mean, the deal-listed liquidity is a very a real relevant topic for all of us in the South African community. If you look at the names like Anheuser, Prosus, Anglo American, etc., British American Tobacco, there's a lot of volume printing away from the South African market. So I'm really keen to hear how you're viewing it on your side, Siobhan, and how you guys are dealing with that challenge in your day-to-day.
Yeah, look, I think dual-listed stocks present their own challenges. But there are also multiple solutions for it, especially for we are a global organization. So if we had portfolio managers that sit offshore, they can very easily access those lines, such as Prosus. But our local portfolio managers, as an example, would need to tap both lines of liquidity. So banks locally can do that very easily, and they have been very good at it. I think what we are experiencing recently is, specifically in the property sector on those duals, borrow is notoriously tough. And what I've seen from some of the desks is that they have come up with solutions to try and make it a bit more seamless, the process a bit more seamless for the buy-side community. And I think it's a good initiative in order to improve liquidity of specific names. One of the challenges that I have touched on with some of the brokers, excluding the banks, is we'd like to see them try and build relationships with the wider sell-side community to be able to access dual liquidity. I know that's very challenging because a lot of them don't have FX desks, and there are other nuances involved. But for us, we like to support the broader sell-side community, and I think a collaborative approach from both the banks and the brokers would be beneficial to our market, and it's something that we would like to see. And I think it's going to be an evolving market. I think you might see names, the amount of dual listed names pick up over time. due to different listing structures.
Yeah.
So the solutions around it need to come in a lot more from the banks, and you guys have been good at it as well. But I'd like to see a bit more. And I think for our portfolio managers, it just makes efficient pricing a lot better. And one more topic on that is, personally, and I'm sure the wider community as well, aren't necessarily going to trade a dual-listed name with an institution who can't access the line, because it's going to negatively affect pricing.
Yeah.
For example, I also had this discussion with someone. I'm not going to give a 100 million rand process ticket to someone who can't access the dual line. What that's going to do is it's going to negatively affect the pricing and the spreads in the local line, and it's not something that we can have. So solutions around that is definitely something that we'd like to see more of, and I think it would be a good step in the right direction.
Cool. Thanks. Yeah, I think that's good, honest feedback, and it's good to hear how you think about that. I mean, Vet, from your perspective, any views?
So I think Siobhan speaks well from the buy side point of view.
Yeah.
It's a requirement for the buy side to be able to tap into the international markets for dual listed stocks. Again, I'm reiterating what I said earlier. We have constraints in our own liquidity, but it's real big, let's call it, respect to our local sell-side communities for actually putting the technology together, putting the funding together, putting the sort of FX trades together to enable the end client to actually be able to tap into liquidity pools in these international markets. So it's a requirement in this market for it to operate in an efficient manner.
Yeah, agreed. I mean, I think on the panel last year, this was actually a topic that we discussed, and Richard from Big XYT had the graphs up, looking at all this liquidity. And I think it's just, as you say, as a sell side, it's absolutely critical that you can provide the best possible outcomes to your client and be able to provide a solution that can get this liquidity. It's absolutely critical. So I think the next topic that I want to touch on quickly is just looking at the facilitation piece, talking about banks' balance sheet and brokers' balance sheet, actually providing liquidity at times, and obviously, there's a benefit to it, but I think one has to also understand the implications of it, and I think it's good that we discuss that a little bit as a community and get the topic out. So, Siobhan, I'm going to turn to you again. It will be good to hear your views.
Yeah, look, I mean, this has always been a controversial topic, the market making and the facilitation piece. Look, when I trade, my first point of call is always natural flow. That's something that is less disruptive to the market. But the final point of call will be market making. If there's no other way out and we're not getting access via dark pools or any other mechanism, then I would go to a bank and ask them for a risk price. The way I see banks is that they are strong partners to the buy side, as well they should be strong partners to the buy side. And I'm not going to go and hit someone up in risk and expect them to do it over and over again without obviously getting recurring business. And I think that's really imperative for proper market structure. Also, maybe a little bit controversial is I'm totally opposed to multi-dealing. And when we see it on our side, you see a list of brokers posting the same flow, the stock goes like this, one directional. I think that's a bit... It makes my life more challenging, especially when we're trying to move large flow. And I know I'm not going to be able to go back to that bank and ask them for a decent risk price. So we try and control our flow and our relationships with banks in a constructive manner so that if we do go to them for a market-making price, we will go to that one bank and we'll allow them to get out of risk, or we'll work in a collaboration with them to do it at the same time. But the point is to have the conversation with the bank on the onset, and basically try and maintain proper price formation post that risk facilitation price. At the end of the day, we're all trying to get the best outcomes for our clients, on my side as well. We manage pension money, we manage retirees' money. So we need the market to function properly, and we need everyone to be a bit more collaborative in that approach.
Yeah. I think that trust element is something that's so important again. It has to be a conversation, and clearly, you don't want to see the risk unwind in the market actually impacting your bigger position that you're trying to enter or exit. As the sell side, what's your perspective?
So I think Siobhan and I probably sing from the same hymn sheet in terms of how we actually partner in this. I think, Siobhan, to that point, the buy side's expectation is it for it to be natural flow. If you look at stockbroking 101, I think from a sell side point of view, no one really wants to put up unnecessary risk if you can find sort of the other side. Yeah. It's kind of natural to be able to actually know where your market is, know where your orders are, so you can actually cross it. And it has the least impact for the market, and it's actually beneficial to the whole sort of exchange and price formation. But again, the sell side needs to stay relevant, and as Woolridge mentioned, we are, as a sell side community, we are very involved in providing services to the client. Mm-hmm. So Siobhan, to that point as well, is when we do need to put up risk, we have to put up risk, but at the same time, we have to be cognizant of risk metrics within brokers and banks. You have a risk manager behind any sort of ticket, so there is generally a strategy at different organizations of how to actually execute out of that. So I think one of the frustrations the buy side will probably see is stocks moving in either direction after a big cross is done, et cetera, but it's never in the faith of trying to hurt one another. It is, again, the management of risk. And I think that's an important bit for the community to understand is there's a service being offered and there's the management. I think Abel Sitole this morning spoke about this room is about people that manage risk, and that's how the financial industry actually operates. Yeah. And I think that's kind of the key in terms of how risk facilitation is looked at.
Yeah, I think that's fair. I think it leads kind of into the next topic we discussed, and Chris, you also touched on it earlier. When at times when we see large and scale orders going through the market, it seems like there is a bit of a reaction. There is a bit of a price reaction in either direction. And there are obviously different ways of reporting transactions to the market. It could be a block trade. It could be XT cross type. It could be an auction on demand trade, etc. Or it could be a central order book cross. And we do see, I think from our perspective, we do see that different order types could potentially create different impact. But I think the other very important aspect here is also how much information is in the market already about certain tickets that are at play. And I think that all those aspects do play into it. But I think, Chris, maybe from your perspective as well, keen to hear some of your thoughts around that. Obviously our market is a bit nuanced in terms of everything gets reported via either a central order book kind of reporting order type, be it XT or the block trade, etc. on the ticker. But keen to hear some of your thoughts around that.
Sure, and it's a really interesting topic, and it's something that we've seen a really interesting pattern in the US and to a lesser extent in Europe. And there's no doubt when a large block goes through, that's a large body of information that there is interest. Now, you know that it was an equal interest from buyer and seller. You have no idea whether there's an overhang, but you know that there's an event that went through. And I think that causes a reaction in markets that's either bad algorithms not stripping out the block print from their calculation of the tape, or that is genuinely an algorithm reacting to that signal that there is liquidity available in the market and going and searching for it. Yeah. In either case, you can often see this spike in liquidity and price action following a block going through. We actually designed a product to take advantage of that because the buyer and the seller knew that they were going to be doing a block trade, so we gave them the ability to not only do their trade and then prior to reporting that trade into the market, place orders limited speculatively on the exchange looking to harvest any liquidity that may be brought in afterwards. So it's a real phenomenon. It happens everywhere. And I think we have to accept that it's there to, it's a natural part of the way markets function. I think, you know, if there is instability that comes through immediately post a print going through, it can be of an advantage, I think, people in the way that I've described. And if that doesn't fit with your execution strategy, then perhaps you take your foot off the pedal for a bit and let the market go through.
Excellent. Cool. I think you know, we're getting close to the end. I think we've got about 3 or 4 minutes left. So yeah, maybe we can see if there are any specific questions from the floor for our panelists. Got a couple, yeah.
Yeah, hi guys. Very interesting topic. Obviously, been at ABSA on a sales trading desk. It's close to my heart to get liquidity done for our clients, and looking after clients is what we do. I think Woolridge, it was very interesting what he was saying about rebundling the market. And rebundling is just a repricing, really. And I think sometimes it's a zero-sum game. If it is facilitation, we should potentially be looking at a slightly higher commission rate. You know, going back to looking how we used to do things back in a high commission rate world. And I think it would provide a lot more liquidity into the system if that was the case. You know, MiFID II has added to those complications. And so how we look at our clients is we do rebundle. It's largely a bundled market in South Africa. We do rebundle it, and we consider the research payment as part of, you know, the overall monetization from the client and providing service and liquidity. But if it was just a simple pricing mechanism, maybe a revisiting of commission rates across the street, I think it would provide a tremendous amount of liquidity in the system. Just a comment.
Thanks. Any
Yeah, no, I'd agree with that. And I think we need to understand as a market that small and mid-cap liquidity, and I think we haven't talked about that enough today, but I think it's at the core. We talk about exchanges not growing and stocks not growing. They start, you get growth in markets when small stocks become big stocks. But we have a market infrastructure now, and it's the same in Europe, that is structurally unable to focus on small and mid-cap names because the price point for research, coverage, liquidity in that difficult segment is not correct. So, you know, we're creating our own problem. And I think, you know, when I started in this industry, it was 15 basis points for a large cap and 25 basis points for small cap, recognizing the different economics of those different segments. We've lost that.
One more question.
Hi, sorry. I've got a question that's a bit different. It's on the dual liquidity. And what do you see the effect of T1 in the States and potentially T1 in Europe and the UK having on our market if we're sitting on T3? If we're tapping into this dual liquidity, who's going to carry that? And what is the impact to our market?
Do you want to take that?
Yeah, I mean, I'm happy to comment on that as well. Yeah, I think that's where the broker and banks come in and have to be innovative in what they do. And essentially, yeah, there needs to be a move of stock, but obviously there could be a borrow and there could be a funding trade on the back of it to facilitate the transaction. And that is a real cost of it. But that is something that you have to consider, and I think, yeah, that's where the innovation piece comes in. But, you know, we're keen to hear your view on it.
Yeah, I think absolutely, as you said, Andres. But what happened in the US when they went T1 is you required a lot more people, just in terms of timing for settlement. So that may create an additional cost to the local broker if Europe goes T1, as an example.
Yeah. No, it's definitely a cost. Yeah, of course. I think that's the key aspect. It has to be taken into consideration, and it is a type of facilitation trade. Yeah. Cool. I think time is up. So I think from my side, just thank you very much again to all of the panelists. I think you guys have been very interactive and open and honest in the conversation, and that's what it's all about. So thank you very much. And thanks to the audience for listening.
Thank you.